Hello everyone, welcome back to one more interesting session where we'll try to understand about what's happening in the global markets, especially US. Right, so this is something that you see on the screen is a guide to the markets, the guide to the global markets. And again, this is being published by JP Morgan Chase and Company, the largest investment bank in the world. Now, again, all these kind of assertions, all these kind of opinions are not mine, right? It is JP Morgan's opinion. And but this guide to market is providing you something which is very phenomenal and which is very interesting to understand that what's exactly happening in the global markets, especially US, from a macro perspective as well as a micro perspective. The earnings growth for the Magnificent Seven, the Magnificent Ten, their contribution towards the total market cap, right? A view upon the global equities, a view upon the global fixed income. Now, again, this is publicly available on the social media platform. You can simply go to Google and type in the Guide to Markets by JP Morgan, and this link will pop up. It's a freely available data. Of course, you can't log in here because you need to be an employee or like you need to pay for this service. But this file, at least, or this link, at least, is something which is freely available. And it will give you a freely available view about the global markets, especially US and different emerging markets as well. So we'll try to decode this in nutshell. We'll try to understand the most important pointers of this and attach the link of the same in the description box as well. Right. So before we go ahead, we're trying to provide maximum value via this channel. Right. जितनी value हम आपको provide कर सकते हैं from a conceptual understanding, we're trying to do that. So this session shall be more towards understanding the global markets from this PDF per se, this link per se. So do not forget to subscribe and press the bell icon. Now, as we go ahead, guide to markets. I'll just zoom in for you. I'll go to the next slide. All this is kind of introduction. I can simply just land in here. I can simply just land in here. I can just go to this slide and then we can just go like to the preceding slide per se, right? So for example, if you see in here, it says that the S&P 500 on a 1 year forward multiple. So it's the price to earning multiple of the top 10 companies and the remaining companies in the S&P 500. So if we see the S&P 500 at the index level, it is currently trading at a 1 year forward price to earning multiple of 21.2 times, lower than the current multiple, which might be somewhere closer to like 26 times, 25 times, because of the earning growth in the Magnificent Seven or the Magnificent Ten, or the top 10 constituents of this index. Because much of the growth in the S&P 500 is coming from the Magnificent Seven or the top 10 companies, right? So specifically, if we just try to see in here, we see on a 1 year forward multiple, the S&P 500 is trading at a 21.2 times and the average has been 16.9 times. If we just take out the top 10 companies from the S&P 500, they're trading at a 1 year forward multiple of 25.1 times and the average has been 20.8 times. And the remaining S&P, that is the remaining 490 companies, are trading at a 1 year forward price to earning multiple of 19 times, whereas the historical 30-year average has been 15.9 times. So based upon the past year averages, based upon the past year price to earning multiple averages, we can clearly see that all the market constituents are trading at a higher multiple. But again, as I've told you in the previous sessions, price to earning multiple might not be a clear indicator to gauge a company's valuation or to gauge a company's future performance. Because the valuations are trading at a higher level versus the past 10-year averages or 30-year averages from past 3 to 4 years. But still, the US markets have been doing good because of the strong fundamentals of the company. So the top lines and the bottom lines of many of the companies in the S&P 500, especially the top 10 or the top 20 companies, are phenomenally well. Their ROE, ROCs are phenomenal, upwards of 20% odd. They're cash generating machines in billions and billions of dollars, right? And that is also the reason that why the price to earning multiple can be manipulative in this way, because just based upon the price to earning multiple, you might assume to sell off the stocks, right? But these companies have been doing well in the previous 4 to 5 years. If I just go in back, if I just zoom out and I just go in back on the very first page, so it basically gives you again the forward price to earning multiple for the S&P 500. This is the cap, the cyclically adjusted price to earning multiple, also called as the Shiller's price to earning multiple. I've told you in one of my YouTube videos how to calculate the Shiller's price to earning multiple. So CAPA stands for the cyclically adjusted price to earning multiple. It simply tells you it adjusted the earnings. It adjusts the earnings against any kind of fluctuations in the market, any kinds of one-time recurring events, extraordinary events in the market. It tends to adjust the earnings. And it also adjusts your EPS, which is a proxy for the profit after tax with inflation. It's an inflation adjusted EPS you tend to take into account. The price remains the same in the numerator, the current market price, but in denominator you tend to take a cyclically adjusted, fluctuative adjusted, or like volatility adjusted, inflation adjusted EPS, which is a much more realistic number, right? So based upon that, the latest number is 41.5 times based upon the cap PE, and the average 30-year has been 28.7x. If you talk about the dividend yield, the current is 1.4% and the average has been 2%. The dividend yield as a percentage of market cap has come down. And that is also the reason that why on a broader basis, the dividends have come down in the US markets. Much of the growth is being driven by earnings and valuation expansion and multiple expansion, but much more due to earnings. And many of the top 10 companies tend to do buybacks instead of dividends. And that is also the reason that why the dividend yield has come down, because much more of buybacks are being done. Earning yield spread, equity earnings minus the bond yield. The average has been 0.7. It's currently trading at minus 0.6% because the valuations are high. Because the earning yield is an inverse of the price to earning multiple. So it's an earning yield minus a 10-year bond yield. Correct? So based upon that, the equity market seems overvalued because the spread is negative and the average has been 0.7%. In case of US markets only, I'm talking about. ठीक है. अब अगर हम आगे बढ़े, again, like the start is also very important. It basically tells you that based upon the current level entry point at a price to earning multiple, what can be a subsequent 1 year return? If the entry point is at a lower price to earning multiple, the 1 year subsequent 1 year returns can be phenomenal. But if the entry point is at a higher level, the 1 year forward subsequent returns might be lackluster. And the same is being shown by this chart. You enter into at a higher price to earning multiple, and the 1 year returns are towards a downward trajectory. And same shows for this chart. All right. Now, if we just go ahead and if we just try to analyze, it says the top 10 weightage in terms of market cap to the S&P 500. That is, the top 10 companies hold 40.6% as the total weight by the market cap size in the S&P 500. And in terms of earning contribution for top 10, it is 33%. Market cap contribution for top 10 is 40.6%. Earning contribution for the top 10 in the S&P 500 index is 33%. I go ahead. This again is a very important chart. This chart is basically telling you the Magnificent 7 performance in the S&P 500. Now it's a price return, only the price return. Now if you see the Magnificent 7 contribution towards the S&P 500 has systematically come down. It currently stands at 29%. Last year it was 46%. It reached as high as 63% in 2023. But now the price contribution, not the earnings contribution, the price contribution, the price performance contribution has been coming down. This is the year-on-year earning growth. You see for the Magnificent 7, it has come down from 40%, then it was 22%, it came down, it rose back to 37%. So again, we cannot just see a clear trend that is the Magnificent 7 earnings coming down or they have been rising. But on a broader perspective, we can see that a few of the companies are declaring very high profits. A few of the companies. I won't be able to name those companies, but a few of the companies, or just 3 to 4 of the companies, have been declared stellar results in the S&P 500 as a part of the Magnificent 7 or the top 10 companies. And this is something that you can see in this chart. A few of the companies have been giving you stellar performance, and the rest have been flattish or lackluster. The Magnificent 7 performance dispersion in terms of price return. ठीक है, अब आगे बढ़ते हैं. Again, this is something that you guys can read. I'll just attach the link of it. Again, this chart is also very important. In the first quarter of the 2026, of the CY26, tech has been the highest contributor towards earning growth, 53% year on year, followed by communication services, 49% year on year, followed by consumer discretionary, 38% year on year. And the rest of the numbers are here. You have materials, financial. The worst has been healthcare. And healthcare is also trading at a higher valuation multiple like versus the other sectors. I'll show you that chart in US. So all this data that we are discussing, it is US specific. It's not India, it's not global, it's US specific. If you see, again, like this chart is also very important. As we talk about the Indian markets, we talk about large caps being the high value sectors and the mid caps and the small caps being the high growth sectors. But in US, the story is completely opposite. The large caps are high growth because of the Magnificent 7, and the small caps and the mid caps are high value. The story is completely opposite in case of US markets. If you see in here that like much of the growth is being contributed in terms of price performance by the tech in 2026 year till date, till March 31st, I'm talking about March 31st, 2026. And the dispersion between the highest performing sector and the next performing sector is extremely high by 29%. If you go to this below chart, even the value as a part of the Russell 1000 is trading at a premium in US, but the premium of the Russell 1000 growth is much more higher versus the premium at which the Russell 1000 is trading at. The numbers are there on the screen versus the long-term averages. 17.1x versus a 14.3x for the Russell 1000 value, and 26.7x versus a 21.5x for the Russell 1000 growth. The markets are at premium, even the value is trading at premium. This chart is extremely important to make you understand from a growth and value perspective, especially for US markets. It states dispersion between the forward price to earning multiple of the S&P 500 stocks in the 20th and the 80th percentile has increased from 11.8 to 16.9. The valuation spread had been 11.8 as a part of past 25 years averages, but the current number is 16.9. So basically what does it mean is in the first 50th percentile, you have the value stocks, the stocks which are trading at a fair value or below the fair value. In the rest 50th percentile, from the 51 to 100, high growth stocks are trading, which might be trading at a value above the fair value. So the stocks in the 20th percentile are cheap stocks or value stocks, we can say in a way. And the stocks in the 80th percentile might be high growth stocks or expensive stocks or stocks trading at a value above the fair value. Now, if the dispersion between these two, the valuation spread between the value stocks and the growth stocks. So if the valuation spread or the valuation dispersion between the value stocks and the growth stocks increases by such a higher margin, it means that the growth might be headwinded in the upcoming months. That is, the growth stocks might correct and the valuations might reach to a fair value, and the value stocks might start to rise from this particular point of time. Or, in other words, we can say that the growth has stopped out and the value has bottomed down. So now the value stocks might do well and the growth stocks might start to correct in the most simpler sense. If I go ahead, again, these have been the contribution. You see that much of the growth is coming in the large cap because of the hyperscalers, right, the Magnificent Seven or the Magnificent 10 per se. But much of the value stocks are present towards the mid cap and the small cap space, the mid cap being extremely attractive. And again, this is attractive from past 3-4 years, but the sector has not performed. The cap has not performed. Forward P 17 times. In India, the 1 year forward P of the mid caps tend to be higher than large caps, but here the story is completely opposite because of the valuation premium due to hyperscalers in the Magnificent 10 or the Magnificent 7 per se. Small cap is at a much premium at 26x. In India, as we see in terms of your fundamentals, or you see in terms of interest or debt, right, or different parameters, the mid caps and the small caps have started to do well. But the story is still opposite in US. In terms of the other parameters, the interest coverage ratios, the magnitude of the unprofitable companies, the mid caps and the small caps still struggle. That is not the story as in case of India. Again, this is something that you can read. If I just go ahead, this is average intra-year decline. You might have seen a similar chart in case of Indian markets also, with the Nifty 50 corrects by 12-13% odd, right, intra-year, right. So that's an average over the past 10 years, 20 years per se. The mid caps correct by some 17-20% odd, small cap correct by some like 25-30% odd. The same chart is there for the S&P 500. Despite average intra-year drops of 14.2%, annual returns were positive in the past 35 years out of the 46 years. And that is something we need to understand. Broadly, the market remains positive. If we go ahead, the major contribution in the country's GDP is coming from consumption, right? 68% is consumption, the same story as happens in India. In first Q contribution, the major investment or the major contribution has come from business fixed investment. Business fixed investment. If we go ahead, this is again a very important chart. We have seen the recent numbers of jobs, around like 1,17,000 of fresh jobs have been added. The wage growth 30-year average has been 3.4%. The recent number has been 3.7%. The unemployment rate on a 30-year average has been 5.5%. But the US has been down at 4.3%. We're still better in terms of employment. So like lower unemployment versus the average and higher wage growth versus the average. If I go ahead, this is the new openings have been falling down in terms of jobs. New hires have been coming down and the layoffs have been increasing. but still there is not much impact upon the wage growth and the unemployment rate. Now, the working class population has been coming down in US. Again, that is for the chart that you can see in here. The much of the growth now is being driven by the output of the workers and not by the population. Because if we try to understand GDP in a way, GDP is a summation of the wages plus profits. Or GDP can also be summed up as the population into the productivity of each person in the population. Right? Higher the population and higher the productivity, the GDP can increase. But it can also happen for the companies like which have reached at a mature stage. The population will get saturated. The population or the aging will start to increase. The working class will come down. But if the output is still intact, if the output still increases, still the gross domestic product or the GDP of that country can still magnify or still increase. And much of the growth is coming from the growth in real output per worker, the blackish grayish part, and not due to the growth in workers. And the same is happening for I would say, the other economies also, be it China or Japan, like more of China. This is the recent number we got, 3.8% for the headline, 2.8% for core CPI. This chart is again something nuanced. So basically, it says that in the long term, the strength of the USD or the currency in the US is being driven by the trade imbalance or the current account deficit. I understand a reserve currency has to run the current account deficits, right? But a longer current account deficit sustained over 30 years, 40 years, 50 periods, higher current account deficits can lower down the currency. So USD will weaken in the long term due to higher long distance current account deficits. But in the short term, the strength of the USD is not being driven by the current account balance as a percentage of GDP. It's being driven by interest rate differentials between the US and its trading partners. If the interest rate differentials are high, then people shall be investing more in US. But if the interest rate differentials between US and its trading partner currencies is less, then you might witness some outflows from the US markets, and that flows might go to some other emerging markets or developed markets per se. If we further go ahead, this is a problem. I don't know like what is happening. Hyperscalers are spending $739 billion in capex. It's expected to rise to nearly $1 trillion in 2028. And now they've all most of this capex till your 2026 had been funded by cash flows. These companies have been huge cash generating machines, but now they've started to take a bit of debt also, by the private credit or long term, short term borrowings. But despite that, the operating cash flows remain positive. The capex, despite that capex, and the free cash flow is also towards a rising trajectory, right? The free cash flows is also towards a rising trajectory. There's a very strong seller fundamental position of these companies. If we just go ahead, the tariffs peaked at 30% in the April 8th of 25. Now they stand at an average of like 10.7% only for many of the countries. If I just go in ahead, uh, nominal yield again expected to rise. This chart shows you the basic correlation between yields of like different tenure with the correlation of the US 10-year yield and with the correlation of the S&P 500. So a treasury inflated protected securities TIPS has the highest correlation in terms of fixed income with the US equity markets. Highest correlation, like one of the highest correlation with the 10-year. Your convertibles, US high yield, will be having the highest correlation with the equity markets. Why? Because US high yield is as risky as equity markets, and convertibles get converted to equities. And that is the reason they have a higher correlation with the US S&P 500. This is the rising trajectory. The curve is getting steepened. We expect the yield curve to rise in US because of inflation. This is again a very important chart from a fixed income point of view. This is basically the option adjusted spread. So basically, if the spread widens, the credit worthiness of the economy or that particular security is hurt. But if the spread narrows, it means that the riskiness in the economy is less or the credit worthiness has improved. So if we see for investment grade bonds, which are high quality bonds in US, AAA, AA, the average spread has been 145 bips. It's currently trading at 72 bips. It means the risk has minimized. Same for high yield. High yield are the triple B, or lower than AA grade bonds, high risk bonds. The average spread has been 501 bips, but it currently stands at 257 bips. It means the risk has been minimized, right? That is also like one of the reasons that why every year we tend to say that recession will hit US, but nahi hota because the spreads are contracting. Even the yield to worst is becoming better. This is again a very important chart. Net debt to EBITDA. This ratio should be as low as possible because we want EBITDA to be higher, the cash profit to be higher. It is 0.3x for hyperscalers. Much better than investment grade, much better than those companies who issue investment grade bonds. They still stand at 2.6x. But hyperscalers, extremely phenomenal 0.3x. Lower the ratio, the best the company is. This is a worrying chart, a bit of worrying chart, but not much. It says tech spreads are wider than the index. I told you that when the spreads become wider, when there is a riskiness in the economy, and why the tech interest rates are getting higher versus the index ka yield or the index ka return is because they have started to take much more debt. And hence now they're funding all the capex, not with the cash flows, but with debt. The tech spreads will widen. Widen. And यहाँ पे लिखा भी है. On the right hand side, we show the tech sector's growing share of the overall, right, the credit landscape. On the bottom right, we show the investment grade tech sector spreads have recently widened relative to the broader market amid AI-driven issuance, fixed income bond issuance. Risk थोड़ा बढ़ रहा है. The biggest contribution towards the Bloomberg index has been from treasuries, agency MBS, and the IG corporates. This is again a correlation chart that you can see. I can just attach the link. This is the predictability of any US investment you invest into against the Bloomberg return, against the aggregate, the Bloomberg US aggregate total return index. As a chart, the chart that you saw in the beginning, the current entry PE indicates some forward returns of the market. The current entry point, as per the Bloomberg US aggregate total return index, it also indicates the future trajectory of the US fixed income markets. R square is 89%. It means 89% of the returns in the fixed income market in US are explained by the Bloomberg US aggregate total return index. Again, if I just go ahead, this is again a very, very important chart. It basically tells you that whatever return a country makes, there are four sources of return. So total return the company makes, the inputs are exactly four. Or the companies or the country's returns are driven by four parameters: earnings, dividends, currency, and multiples. Over a 15-year past historical annualized basis, the US market has been driven much more due to the earning expansion. Japanese markets again by earnings expansion. Eurozone, it has been a combination of earnings and dividends, but much more of dividends. EM market has been again a combination of earnings and dividend, but much more of earnings. China market has been a combination of much more of dividends. What happened in 2025? The Eurozone's companies' returns were driven completely by currency because the euro currency appreciated by 20% odd against the USD, and also by the multiple expansion. Earning थी ही नहीं. EM, earning and multiple expansion. China, morely due to multiple expansion. Japan, a combination of earnings and multiple expansion. US has been phenomenally earning growth. Higher PA, but earning growth BM. So what's the expectation? What has happened in, I would say, in 2026 vital date? EM has contributed the most in terms of earnings, 25.7%, followed by US in terms of earnings like 11.3. This then by Japan, then Eurozone, China expected to be negative. So emerging markets, US markets, and Japanese markets are expected to be driven much more due to earnings. And EM is being contributed much more by South Korea and Taiwan. After that, you have Brazil, right? A bit of South Africa, Vietnam, then maybe India. There are different charts that you can see. एक और इसमें chart था, maybe I just want to show you that. Gold is bound to be a less volatile assets, but due to the recent performance in the gold or performance in the gold, the volatility of the gold has become highest among the large caps in US. The highest risky asset or the highest volatile asset in US has been gold, followed by the S&P 500, followed by the 60-40 portfolio in which you have 60 equity and 40 debt, followed by the US aggregate. which is the bond index. So this is basically what I wanted to show you as an update. एक चीज मैं आपको और दिखाता हूँ. This is the bulls and bears being published by Motilal Oswal Asset Management. I'll just share the screen also with you. This is a publicly available data for those who are part of my groups. They have the access to already. एक चीज मैं आपको दिखाता हूँ. So these are the multiples on a 1 year forward basis in which different markets are bound to trade. So US markets are bound to trade at a premium. MSCI EM is trading at a discount. China is trading at a discount. Japan markets, Taiwan market, Korean market are trading at a premium. UK, Germany, Brazil, Indonesia at a discount. Why you see? India is expected to trade at a 1 year forward multiple of some 18, 19 times. US at 21 times or like 22 times. MSCI EM at a discount 13.1 times. China 14.1 times. Average multiple for China has been 10 times. तो अपनी मार्केट के बेसिस पे इज ट्रेडिंग एट अ प्रीमियम और वर्सेस इंडियन मार्केट्स इज ट्रेडिंग एट अ डिस्काउंट. Japanese market again is trading at a premium. Average premium for Japanese market itself has been some 17 times odd. Taiwan markets is 21 point is like 21.9 times. Again trading at a premium. Brazil, UK markets are trading at a fair valuation, but again at a lower premium versus India. Let's look at the ROE. Highest expected ROE for the FY27 is expected by the Korean markets at 23%, followed by the US markets at 21.6%, then Taiwan 20%, then MSCI EM 17%. Even your UK markets or Brazilian markets are bound to give you higher ROE versus India, and then you have India here. Right? So this is in terms of expected ROEs because it's very easy to talk based upon multiples. ठीक है, मल्टीपल्स के बेसिस पे बात करना बहुत इजी होता है कि दिस मार्केट इज ट्रेडिंग एट अ हायर वैल्यू देन सेल दैट मार्केट. दिस मार्केट माइट बी ट्रेडिंग एट अ लोअर वैल्यू. द अर्निंग्स आर 233% in Korea, more than 200% in Korea. Expectation is more than 50% for Nasdaq, for emerging markets, MSCI EM and Japan expected to grow by more than 50% odd. Taiwan again by 50% odd. Japan is 35% odd. Brazil by some 15-20%. India at some 9-10%. But it's important to judge based upon ROEs. If these companies are commanding a lower price to earning multiple on a forward basis, Korea ka 1 year forward multiple is 9.7 times. The recent number is 7 or 8 as of June, I'm telling you. Right? So if these companies are trading at a lower multiple, especially South Korea and Taiwan, I would say, and with a very high ROE, then these companies are sheerly undervalued. They can command a higher premium too. But now there is always an expectation in the market that the semiconductor, this AI boom, chip boom has reached the bubble, right? And will start to correct. And in that phase, we might see for the first time ever that a low P market or a low value market witnesses a crash or a major correction, which usually happens for a high P market. So the markets have evolved, the markets have changed, and these have been the changing dynamics. So ये update था for basically from a global markets perspective, emerging market perspective. मैं लिंक अटैच कर दूंगा in the description box. So again, if you're liking this content, do subscribe and press the bell icon to get all these updates on continuous basis. मिलते हैं जल्द. Thank you so much. Take care.